The precious metals markets are experiencing a seismic shift, one that has sent shockwaves through the financial world. We are witnessing prices move in a way that many thought was impossible just a short time ago. Silver has made a stunning move, surging past the critical $53 per ounce mark. This isn't just a minor fluctuation, it is a powerful statement from the market. This surge has captured the attention of investors everywhere, from seasoned professionals to everyday people who are now looking at silver in a completely new light. The momentum is undeniable, and it suggests a fundamental change is underway in how these metals are valued. This incredible movement in silver is being matched by equally breathtaking predictions for gold. Experts are now seriously discussing price targets that were once considered extreme. Some of the most respected analysts in the industry are forecasting that gold could climb as high as $5,000 per ounce. This isn't just wishful thinking. It is based on a careful analysis of global economic conditions. Financial giants like CNBC and Société Générale, or SocGen, are adding their voices to this chorus. CNBC has floated a potential price of $100 for silver, while SocGen is looking at the $5,000 gold forecast. When institutions like these make such bold calls, the world pays attention. The question on everyone's mind is, what is driving this explosive price action? It appears to be a perfect storm of factors converging at once. We are seeing unprecedented demand coupled with growing concerns about the stability of traditional financial assets. Investors are searching for safety, and they are finding it in the timeless security of gold and silver. These metals have served as a store of value for thousands of years, and in times of uncertainty, their appeal only grows stronger. This is not just a speculative rally, it is a flight to quality on a global scale, and it is reshaping the investment landscape before our very eyes. The psychological impact of these new price levels cannot be overstated. When silver breaks through a significant barrier like $53, it changes perceptions. It forces even the most skeptical observers to reconsider their positions. Similarly, a $5,000 price target for gold from a major bank like SocGen gives credibility to the idea that we are in a new paradigm for precious metals. This isn't about chasing quick profits, it's about understanding a fundamental revaluation that is taking place. The market is sending a clear signal that the era of cheap gold and silver may be over for good, pushing investors to act now. One of the most startling events to rock the silver market recently was a single, massive trade that occurred under the cover of night. A buyer, or group of buyers, executed a trade so large that it was equivalent to a staggering 12% of the entire world's annual mined silver output. To put that into perspective, imagine someone buying 1/8 of everything a global industry produces in a year, all in one go. This single transaction has sent a powerful message. Someone with very deep pockets is making a huge bet on higher silver prices and is worried about being able to get their hands on the physical metal in the future. This massive trade is a clear indicator of a much larger problem, a severe and intensifying shortage of physical silver. The demand is simply overwhelming the available supply. This isn't a theoretical problem. It is having real-world consequences right now. Across the United States, reports are flooding in that physical silver dealers are being forced to halt sales. They are not doing this because they don't want to sell. They are doing it because they cannot secure the inventory. Their suppliers are running dry, and the premiums to acquire what little is available are skyrocketing, making it impossible to conduct business as usual. The situation has created a sense of urgency, bordering on panic, for those who want to own physical silver. When you can no longer walk into a dealer and buy a silver coin or bar, it confirms that the paper market and the physical market are telling two very different stories. The paper market may show one price, but the reality on the ground is that the metal itself is becoming incredibly difficult to find. This disconnect is a classic sign of a market under extreme stress. It suggests that the true value of physical silver is much higher than what the screen prices have been indicating until now. This scarcity is not a temporary glitch in the system. It is the result of years of growing demand from both industrial users and investors, which has steadily drained global stockpiles. Silver is essential for solar panels, electric vehicles, and countless electronic devices, and that demand is not going away. When you add the massive surge in investment demand on top of that, you have a recipe for a supply crisis. The huge late-night trade was a wake-up call, signaling that the big players are now moving aggressively to secure their share before there is nothing left to buy. The dramatic events in the gold and silver markets are not happening in a vacuum. They are directly connected to a much bigger story about the health of the global financial system. For years, there have been growing concerns about the ever-expanding mountain of United States government debt and the stability of the US dollar. Today, many believe that the dollar and debt bubbles have merged into one and the same issue. As more and more currency is created to service this debt, the value of each individual dollar is diluted. This erosion of purchasing power is a major worry for nations around the world. In response to this growing risk, central banks globally are making a significant change in their strategy. They are turning away from holding paper assets, like United States Treasury bonds, and are instead rushing to acquire real, tangible assets. Gold is at the top of their shopping list. These institutions are not speculating. They are making a calculated move to protect their nation's wealth from currency debasement. When the world's largest and most powerful financial institutions start buying gold hand over fist, it is one of the strongest signals you can get that they are losing faith in the current paper money system. This shift by central banks is a massive vote of no confidence in the future of fiat currencies. They are essentially admitting that they see trouble ahead and are preparing for a world where physical gold is the ultimate safe haven asset. This buying spree adds another enormous source of demand to an already tight market. Unlike individual investors, central banks buy in massive quantities, taking tons of gold off the market at a time. This has a profound effect on supply and is a key reason why many analysts believe prices have nowhere to go but up from here. The behavior of these central banks provides a clear roadmap for any individual looking to preserve their own savings. If the institutions that manage entire national economies are diversifying into gold and silver, it is a prudent strategy for everyone to consider. They are seeking protection from the very monetary policies they help to create. This move toward hard assets is a defensive one, designed to shield their reserves from the inevitable consequences of endless money printing and ballooning debt. Their actions speak louder than words, confirming that real assets are the ultimate insurance policy in uncertain economic times. We have entered a new era for precious metals, one defined by scarcity. For a long time, investors could easily acquire gold and silver at prices that did not reflect the growing risks in the financial system. That time is now over. The combination of relentless central bank buying, massive institutional investments, and a surge in demand from the general public has fundamentally changed the market dynamics. These metals are now much harder to find, and this scarcity is becoming the new normal. The days of taking supply for granted are behind us, and this reality is being reflected in the soaring prices we see today. This environment makes gold and silver more important than ever for individuals who want to protect their savings and purchasing power. As currencies like the dollar face pressure from debt and inflation, holding wealth in paper assets becomes increasingly risky. Gold and silver, on the other hand, have no counterparty risk. They are not someone else's liability. They are tangible assets that have preserved wealth through every financial crisis in history. In a world of digital money and complex derivatives, their simplicity and reliability offer a powerful form of financial security that cannot be replicated. The potential for prices to continue rising is significant, with major banks forecasting $5,000 gold and silver shortages making headlines. The upward momentum is strong. This is not just a passing trend, it is a fundamental revaluation based on the law of supply and demand. As more people wake up to the risks in the broader economy, the rush into these safe haven assets is likely to accelerate. This will only put more pressure on an already strained supply, creating a feedback loop that could drive prices to levels that are still hard for many to imagine right now. Ultimately, the message from the market is clear. The financial landscape is changing, and the role of gold and silver as essential components of a diversified portfolio is being reaffirmed. They are no longer just an alternative investment. They are becoming a necessary one for anyone serious about wealth preservation. The challenge now is not deciding whether to own them, but securing them while they are still available. As scarcity becomes the dominant theme, those who have positioned themselves in physical gold and silver will be best prepared for the economic uncertainties that lie ahead.